Hello everybody, it's January 10th, 2008. I want to do a quick rundown of what I think the markets are shaping up. It might be a little bit of a help to some people to start honing their eye to that sort of thing. There's a lot of power in kind of listening and sharing ideas, so here we go. This S&P 500 ETF, good place to start. So here's a nice 6-month chart. You can even go back and look at 2 years of data just to see what's going on in here. Nice uptrend, they'll sell off, good move up again, deep correction, rally, and now we're kind of back down there. So nice weakness in here, shaping up. I'd like to see a little bit more of that, so I can zoom in now, go very quickly in here, and I have a nice small chart, so we're going to go even deeper now into a 3-month chart. Very good. So this stock has made a series of lower highs now through here. A little bit of a higher low through here, nice. A bit of a wedge formation, in fact. A lot of the other stocks in the market are looking exactly like this now. And I mentioned in the last video that I would be looking for stocks that are holding up compared to this, or looking even weaker compared to this to go long and short in when they set up. All right, so this stock is down 1, 2, 3, 4, 5, 6, 7, 8 bars in a row with an unfilled gap in the middle of that. They call that a hole in the wall. And again, I'm using nice charts here from Thinkorswim. Very, very helpful to use those if you need to. And after 8 bars down in a row, I'd mentioned before that not a lot of people who know what they were doing are going to sell a stock short after it's been down 8 bars in a row. It's far too risky. So if stocks move in 2 to 6 bar moves or 2 to 8 bar moves, that's going to be what I would consider to be the mean of a stock's movement. And if you go back and look at any chart, I'll just bring up anything here. Let's bring up Agilent just for fun. It's very rare to find a stock that will go up or down more than 6 or 8 bars in a row without putting in a swing high or a swing low. Right, so we can go back and extrapolate that back and say a nice 4-bar move would be right in the mean. All right, probably within one standard deviation of that mean would be 3 or 5-bar move, 2 or 6, 1 or 8-bar moves. So you get the idea that's moving further and further away from that. What would be the chances, I always mention this, of flipping a coin and hitting heads 20 times in a row? Very rare, right? Same with a stock, having it go up or down 20 bars in a row is almost unheard of. It can happen. You don't ever want to step in front of that train or try to catch that falling knife. But when stocks are down so far, I also don't go short in the broad markets if they look like this. I'm very wary about shorting other stocks that are setting up in that scenario. All right. Nice point there is if the broad markets are down and a stock is holding up, basing sideways, getting ready to break down, or even rallying back up, getting ready to roll over, that's showing relative strength compared to the broad market. And it's going to be something that I would probably want to avoid until the market rallies and I can watch the strength of that individual stock in context with the broad markets. So it's a little bit easier for me to go short in a long broad market environment because that is relative weakness makes it a little bit easier to see, I'll say that. Anyway, so after 8 bars in a row down, the stock now bounces 2 days up. Nice big move up today, in fact, a little bit of a sell-off toward the end of the day here. And so where would I be looking for this stock to stall? It actually did that to the penny. So this is a great place to look for resistance in a chart. So this gap is still unfilled. All the people who were looking to buy that stock anywhere through here now get hurt even further on a gap and another 3-day subsequent decline. They're in major pain, and they're going to want out when the stock market runs back up to their level. That is the definition of overhead resistance. Very powerful to understand the market psychology behind this and then take it and start making money with it. So understand it first at the highest order, and then you'll be able to start making money with these concepts going forward. So great resistance through here. Say there are X number of people trapped in here. They have not kept a protective stop. Some did, and some did leave the scene. That's why this increasing volume is so alarming here. But some did not, and now they're going to want to sell when it comes back up, like I said. So what I would do is I would put resistance lines like that in. There's a good one here, good resistance here, all the way up through here, even back here. So I can then take and do a Fibonacci retracement, which is great, and we'll now measure the bounce that we get. Let's see if I can grab that. It's being feisty. There we go. Alright, so a 50% retracement of that sell-off would be right to here. And so I'll just drop that line in, like so. So this stock bounced almost all the way back up to the 50% retracement of that original sell-off. Nice interesting reason why things can fail at the 50-yard line here is because people who bought it up here, let's say they paid $150 for each share. If they buy an equal number of shares down at the bottom and it bounces up 50%, they get a chance to get all their money back, not just half of it. And that's going to be a very, very powerful motivator for people to exit that trade. So a lot of times stock will fail or stall around the 50-yard line because of that. All these other numbers are more and more powerful as well. So what I do is I measure those bounces on the fib lines and say if the stock only were to bounce up to the 23 level, 23%, and chop around at the bottom, that would be a nice low base, getting ready for failure. If it was to retrace 100% or even more than 100% of that sell-off, that would be X% more and more strong. And I've mentioned this before in one of my Fibonacci movies, but it's happening right now in the broad market, so I wanted to mention that. So I'd be very, very careful about going long here, even though the market could go up forever. But I'm also below all the moving averages here. One nice thing we do have is, if you look at a 2-year weekly, you can see where the stock is bouncing. It's bouncing almost exactly on the 100 MA here. It's kind of hard to see it scrunched up like this, but that's a very good bounce. A lot of people watch that, but now we're still trading below the 50 MA. It did well, it did well, it did well. Ran up to new high, pierced it a couple times. That paved the way for further failure after a lower swing high there. And so we're in an interesting area in the market. I'm still not going to deviate from my plan. I'm going to look for relative strength stocks and relative weak stocks, but not necessarily trade the broad market right now or anything that looks like the broad market. So I just wanted to mention that. Hope this is again helpful, and I'll talk to you soon. Hope you have a great weekend.